So lots of news for the markets to digest as it was bombarded with unfortunate and dismal news from all ends. How did it react? Well, it did pierce some crucial levels on the downside backed by very strong volume activity. The Sensex ended lower by 285 points. The Nifty was below 5750 by the day's close, although both the benchmark indices did recover from the low point of the day. The broader markets too didn't see as strong a recovery and they ended close to the lowest point of the day, so off by 1.5%. All of your sectoral indices were in the red. Realty saw carnage, capital goods, metals, PSU, so no sector was spared. Big losers included BHEL, Bharti Airtel on the back of that dismal news, DLF as well as Reliance Infrastructure. You had all of the SR counters like SR Shipping, SR Oil, all of those were also in the limelight on the downside on the back of Shyamlal Ghosh, Aseem Ghosh as well as Ravi Ruia being summoned in the Spectrum case. Apart from that, SAIL was in the limelight on the downside as Newswire sources indicated that the advisors are suggesting 60 rupees as the floor price for the divestment. On the back of that news, the counter ended lower in the session. Sun TV and SpiceJet, both of those counters were heavily hit. In fact, Sun TV ended below some of its crucial daily moving averages on account of sentiment turning bearish after the DMK pulled out of the UPA government. Infrastructure stocks from the mid-cap space, the likes of an IVRCL Infra, IRB, NCC, Unitech, so real estate and infra as a pocket was very weak today. You had a Manappuram Finance which was smashed in the session. In fact, it hit lower circuit. The management said that they expect a 250 crore under recovery during the current quarter and a loss of close to 50 crores in the current quarter, and the full year profit for FY13 at 300 crores. Taking down with the Manappuram Finance was also a Muthoot Finance, which ended sharply lower in the session. Gammon Infra, that one saw a little bit of a winning streak as it is in talks with its lenders to restructure debt. Some of the gainers included GAIL, Bajaj Auto and Ranbaxy.
Commodities now, where we have seen some gains now come back in case of the gold prices, which is holding around that 1590 mark into the international markets there. The Indian markets, of course, have seen a bit of a gain come back as well because of the rupee depreciation coming in there. But if you look at the industrial commodities, you have seen constant declines at least coming in for that space, especially in case of crude, where we did see prices gain up in the New York markets yesterday. But then again, ahead of the Cyprus vote on the bailout and, of course, ahead of the US inventory on a weekly basis, we have seen some pressure building up in that space yet again. Same is the case with the base metal prices as well. Copper prices are trading at around 4-month lows. Ditto is the case with zinc as well, and we have seen COMEX and Shanghai metals also continue to decline. That's a fresh 0.25% decline coming in, especially in case of the LME copper. Let's get in then Ravindra Rao. He's Associate VP Commodity Research, Motilal Oswal, and he joins us live on the show. Ravindra, hi, welcome. Let's start with gold first, and we have seen some amount of consolidation coming in yet again. 1600 is holding, but are you looking at gains much further from here?
Good afternoon, Manisha. Yeah, I feel on COMEX we might see gold moving up till $1612 again, which is a resistance, and if that breaks, it might go to hit 1620, which was the high hit on February 26th. On MCX also, the rupee depreciation is supporting the prices, and technically also the prices might bounce back till 29,700 to 29,750. So yes, there is a possibility of a bounce back, but the overall trend in gold still remains bearish until 1620 holds on the upside in COMEX. So for the day, I would recommend a buy in dip towards 29,540 levels. The strict stop loss of 29,450, and on the upside we can take a target of around 29,700.
Ravindra, would you say that much of the gains that we have seen coming in for the Indian commodities today is because of the rupee depreciation? We did see the rupee appreciate when the markets opened. 53.90 is the level that we saw, but it's holding around 54.30 back in yet again. So is that how the calculations are happening for us today?
Yes, that's right, because when rupee was trading at around 54.10, 54.15 on MCX, gold prices were trading at around 29,520, and now the rupee has spiked up. The March contract is trading at around 54.45, and in MCX we have seen an up move of almost 100 rupees from 29,520. So that is an important factor today, and also the COMEX prices, I'm expecting in the evening session it might again move up towards 1612 levels, so that again will support the prices. So it would have a double impact, and M6 prices might gain upwards in the evening session.
Ravindra, also what's your sense coming in for the silver prices now? Yet again a slight decline coming in for the international markets, but India has seen gains coming in.
Again, the rupee depreciation is supporting silver prices in the domestic front. On MCX, I'm expecting the prices might move up till 54,700. That is where it should take a resistance, and from there it should fall. The weakness in the base metal is not allowing silver to sustain on higher levels. But still, going as per the technicals, I feel 54,700 is on cards on MCX, and from there we might see again a selling in this metal. For intraday, 54,000 is holding very firm. So I would maintain a protective stop of around 54,050 on the lower side, and a dip towards 54,250 can be bought. On the upside, we can take a target of 54,700.
Ravindra, you mentioned about the base metal prices, and this sector really has been the most hit. How much of a further decline are you expecting here? And for the intraday market, what would your strategy be?
Technically, the charts are pointing quite lower. In copper, I'm expecting the prices might even fall till 400 levels in the coming sessions. But intraday, from the intraday perspective, I think 412 is a good support in M6 copper, and we might see a bounce back, because yesterday we had seen a fall of almost 2.5 to 3% in MCX as well as in LME copper. So I think a bounce back is possible towards 417 to 418. So intraday, it would be a slight risky bet, but still I think selling here would not be advisable, because it is already down almost 3 to 3.5% from day before yesterday's high. So I would recommend buying at these levels. On the upside, we can take a target of 417 to 418, and that would be a very good level to short again in copper, and from there we can see a dip towards 408 to 405.
Ravindra, what's your sense coming in for the energy pack? On one side it's Cyprus, on the other side it's the US weekly inventories, which are expected to be bearish for the prices yet again. But how would you want to trade them today?
I think crude is approaching the resistance level. We have seen on NYMEX it is not breaching $94. On MCX, yes, it has moved up again thanks to the depreciating rupee. But I think on MCX again it is taking resistance at around 5140 levels in April contract. So I think we should go for a sell from intraday perspective, and we can take a target of around 5080 on the lower side. But yesterday's Saudi statement from Saudi minister, and also the Libya clashes has taken crude slightly higher, so that should be watched for. And apart from that, I think for intraday it's a sell. On the lower side, 5080 could be used as a buying opportunity.
Bharat Kumar, director at GFM, joins in on the show. Bharat, hi, afternoon. Let's start off with your view on gold.
I think in case of gold, we have seen buying again coming into picture after the Cyprus financial crisis. So to that extent, I think the trend is still intact, even in case of COMEX gold. Of course, the short medium-term trend is neutral. Its range bound between $1620 and $1565 on the lower side. But nevertheless, I think in case of short-term trend, the trend is slightly bullish, wherein we can expect around $1615, and then afterwards $1620 on the higher side. Even in case of M6 gold, I think unless it closes below 29,000 ranges, the major trend is still intact, and probably one should go for buying in dips maybe to an extent of around 29,500 ranges. It stops below 29,390 ranges. On the higher side, we are expecting market to test around 29,850 ranges in due course of time.
What about crude then? How would you advise the traders to play crude today?
In case of energies, especially crude, after yesterday's gap down opening during the Asian trade, we have seen the prices again catching up in the New York session. The major trend is still intact. Till the NYMEX crude consistently trades beyond $91.90. On the higher side, of course, the major trend may reinitiate as it consistently trades beyond $94.50. Even in case of NYMEX, I think one should hang on to the long positions with trailing stops below 5095 ranges. In case of April crude, on the higher side, we're expecting around 5160 ranges. For the medium-term trend to re-establish, I think it should consist to trade beyond 5160.
What the market has been up to, and clearly a strong bout of recovery from the lows of the day. A good 141 points off the day's lows for the Bank Nifty, and the Nifty too after the sharp knee-jerk reaction as soon as the political developments actually unfolded, the DMK pulling out of UPA. You did see a sharp nosedive coming in for the markets. Now we're back above the 19,000 mark when it comes to the Sensex, and the Nifty currently back at 5750. Still under pressure, metals, autos and high beta trades like real estate still continue to languish. But on the flip side, you are seeing gains come in for Bajaj Auto, Lupin, ITC, Sun Pharma as well as Ranbaxy. So clearly the defensive trend in the market.
On board Michael Kurtz, Chief Asian Equity Strategist at Nomura. He joins us from Hong Kong. Michael, how do you see Asian equities as an asset class? So far, so good, but does it? Do you think the springtime for Asian equities is over?
Yeah, Asian equities still look to us like a pretty good play on both the recovery and global demand growth underway, and I think really principally with the U.S. economy as a critical driver there, Asia giving you a lot of leverage on that pickup in U.S. demand through the export sector. But still with a fair amount of value to be found in the region, and at the same time, at least the potential backstop of Chinese demand growth as well.
So you don't see any signs of fatigue in this risk-on rally then?
I wouldn't quite say fatigue so much as a need for a healthy consolidation. Stocks have come a long way since the middle of 2012. They are a lot less deeply value than they were back in the middle of last year. But we don't believe that the underlying driver here, which is a combination of a pickup in global demand and an ongoing flow from one asset class to another, primarily from fixed income into equities, neither of those two drivers have really exhausted themselves yet.
Michael, how do you explain the disconnect between rising valuations and when earnings momentum is slowing? Are markets already discounting a earnings trough though?
It certainly does look as if stock prices have already moved ahead of the earnings consensus numbers. So in that respect, we could surmise then that equities are assuming a certain amount of upgrade yet to come. And that does probably mean that going forward, upside for Asian stocks is going to really rest a lot more on the liquidity argument. We do need to see ongoing evidence of money coming out of those safe haven type assets, fixed income, money market funds, etc., and into the more growth sensitive or more inflation sensitive asset class that is equities. There is evidence that that rotation is well underway, and certainly no reason to believe that it is by any means near the end of its course yet. But we do need to see the liquidity, I think, in order to keep the Asian equity story moving.
So what makes you bullish in emerging Asia? Because your report talked about best emerging market combination of value and growth. Can you give us some more color on that?
Well, in Asia, we think you get effectively a sort of leverage on developed market growth. And so while the U.S. recovery really for us is the principal backbone of a global demand pickup over the next 12 or 18 months, the fact is that Asia historically gives you earnings leverage on that pickup in the U.S. In fact, over the past decade, for every 100% increase in U.S. earnings, we would expect to see about a 250% pickup in Asian earnings. So it's a more than 2-to-1 sort of leverage on the earnings recovery. Asia is still value in the sense that you're getting it at least small discounts to long-term average PE multiples or price-to-book multiples. Although admittedly at this point we're talking about single-digit discounts, nothing like the double-digit or almost 20% discounts that you could get 12 months ago.
Michael, what about India? Do you find Indian markets are reasonably priced? And what kind of growth are you penciling down for Indian markets in 2013, which is the current calendar year?
India looks a bit challenged to us, in fact. The market overall is selling at just about 13.5 times forward earnings. And while that's no worse than about in line with long-term averages, it is a long-term average that was established during a period when India was growing considerably more strongly than it is today. So, for example, the 8.5% type GDP growth numbers that we saw in India not more than just 4 or 5 years ago are now down in the neighborhood of 5.5, which is basically what we're looking for in 2013. And from that perspective, you could argue that Indian equities are at this point still relatively aggressively valued, because in line with long-term averages that were established at a much higher growth rate than we're seeing today suggests that equities are not really yet fully sort of in touch with the slower growing reality of India today.
So, Michael, looking at the backdrop of risk appetite improving, how would you play equities, defensives or cyclicals? Is it time to add beta to one's portfolio?
There are still quite a bit of uncertainties out there in global markets today. A lot of questions about, for example, Chinese policy and the reform outlook under the new Xi Jinping, Li Keqiang administration. There are still some pretty substantial uncertainties emanating from Europe, between Italian politics on one hand and the Cyprus bailout on the other hand. And even in the U.S., which we still think is pretty much a bright spot in the global opportunity set, there is still, for example, the unresolved part 2 of the fiscal cliff. So with all of these uncertainties out there, admittedly, investors may want to hold on to some relatively defensive positioning. And certainly within Asia, we think the telco sector gives you the best combination of, relatively low cyclicality, low beta, but relatively high total returns because of the, in most cases, pretty robust dividend yield that you get from that sector. But otherwise, looking around Asia, we really do see some of the deepest value in the higher beta type sectors. I would point in particular to both the tech sector and the consumer discretionary sector as being deeply valued and still, quite a bit of leverage in terms of cyclicality. And then within the financial sector, maybe in particular banks and brokerages, we see interesting opportunities there, both from the standpoint of value and from the way that they would benefit from an ongoing steepening of the yield curve and improving global growth outlook.
Michael, so finally, what are you expecting from the Fed later this week? Do you see any kind of danger to the rotation rally if indeed the noise on Q3 exit becomes louder?
This is probably going to be a relatively inconsequential Fed meeting in the sense that we certainly don't expect any major changes to their forward guidance. I think that Chairman Bernanke probably felt a little stung by the market response to the January Fed minutes that were released about a month ago, 3 weeks ago, in so much as even a relatively sort of indecisive suggestion that the FOMC was not foursquare behind sort of keeping QE in place for as long as it is blueprinted for, was actually a major shocker to markets and tipped off quite a bit of volatility in the near term. With that experience still pretty fresh in his mind, we think that the Fed chairman is going to try pretty hard to maintain a message of continuity in monetary policy. And as such, we're likely to see very little more than perhaps a bit more elaboration on the issue of the costs versus the benefits of QE, but one that clearly resolves in favor of the benefits still being by far the more important consideration for the time being.
Michael, good chatting with you. Appreciate you taking the time out and joining us.
Ahluwalia, Deputy Chairman of the Planning Commission. Mr. Ahluwalia, before we get to the credit policy, a quick word from you, because the market seemed to be in a bit of a panic mode on account of the DMK pulling out of the government. We just heard the Finance Minister indicate that the matter is under the consideration, and they're hopeful of getting some sort of a resolution through. What would you advise investors, because there seems to be a certain amount of panic in the market?
Well, markets will react to political developments on a minute-by-minute basis. I don't have any advice for the markets, but I think these are issues that are somewhat different from the fundamental economic situation and the strengths of the economy. And actually my advice to markets would be that they should not be too distracted by political events, which will be managed in the right forum. They should be really focusing on the economic situation, which I think is looking better.
But do you think there's no threat to, because at the end of the day markets don't like political risk, and that's the reason I asked you that question, and a lot of the rally that we've seen played on equity markets has largely been driven by foreign flows, and that's what has been financing our current account as well, which is why there's this fear in the market.
I have no doubt whatsoever that on the day there is some political event, you can see a lot of volatility. Some of it is perhaps even manipulated, but over a period of time markets will reflect economic strengths. I don't think that they should be focused on individual political events, though I recognize that those obviously attract a lot of attention. I have no inside knowledge on how the political side is going to move in this matter, but you can't stop markets from essentially playing out whatever they feel is relevant from the point of view of the future. By and large, I think markets should look at what the economic strength is, and I don't think these things affect that too much.
But what about the image factor, Mr. Ahluwalia? You know, at a time when Indian markets are completely hostage to global cues, such a news development I'm sure will have impact on India's image and the stability.
I don't think that it will. I think people are aware that we are a functioning democracy, and in a democratic system you have to manage different people's perceptions of events. I think it's a test of the system whether it's able to do that well, but I don't think it affects India's image negatively. I think what it shows is that people do take positions which are very often quite different, and the system knows how to manage them.
Just a quick word on this before we move to the credit policy, Dr. Ahluwalia. So essentially, there is no threat to the government, or you think such fears are a bit unjustified, that, you know, that there is stability in the centre?
I think on this matter, the finance minister has already made a statement. He's much more aware of what's going on minute by minute. So I would leave markets on this matter. I would advise them to judge by what the finance minister has said. And I'm sure that they will be doing so.
Your reaction to the credit policy then, because we've seen the central bank cut policy rates by 0.25 percentage point, which is again largely along expected lines, but the commentary probably isn't as dovish as markets would have liked it to be. The RBI indicating that there's little elbow room for it to cut rates from here on, even though it wants to maintain a pro-growth stance. How would you read into these comments?
Well, I think the most important thing about the rate cut is that it is a clear signal on the part of the RBI that although the global situation is difficult, and there are domestic problems also, the fact is that inflation, though still uncomfortable, is subsiding, especially non-core inflation. I think the governor has said that more fiscal room has been created, and I read the rate cut as a signal. I know that industry is disappointed because they would have wanted a stronger signal. But you know, monetary policy is not like fiscal policy, where once you produce a budget, I mean, that's it for the year by and large. I think monetary policy can be adjusted as the situation develops. That's what they've done in the past. Some people feel that the rate cut could have been larger. I think it could have been. But broadly, the important thing is the signal it gives. You know, I must emphasize that unlike in other countries, the rate cut here does not actually translate all that automatically into pumping liquidity into the system at a particular rate. The Reserve Bank governor has said that they're watching the liquidity situation quite carefully and will make sure that there is no imbalance there. So I read that as a positive signal, perhaps less than what many people in the industry were wanting.
Mr. Ahluwalia, several bankers whom we've interacted with after the policy, they are of the view that for PSU banks it will be difficult to really pass on the benefits of this rate cut, which means the policy transmission may not happen.
Well, you know, this is something that many people in the industry don't realize, that the repo rate does not translate automatically into greater liquidity, for the simple reason that nothing pushes the Reserve Bank to lend limitlessly at the repo rate. The repo rate is actually a signal of how the Reserve Bank sees the situation as evolving. Is it a signal that monetary policy should now move towards a more supporting growth position or towards a constraining demand position? And I think that signal is very clear. Now, as far as the banks are concerned, I mean, whether they can lend more is going to depend on their own resources position, how their deposit growth moves, and also at what rate they can attract deposits. And that rate, to some extent, depends on what's happening to inflation. So all these things are interconnected. But the idea that by simply lowering the repo rate, you can lower the long-term interest rate, I mean, that's just not correct. So there's no surprise there. But the fact that the RBI is giving a signal will influence banks, because within themselves, if they were wondering, are things appearing to improve or not, the RBI is validating the judgment that things are getting better, and hopefully banks will respond accordingly. But it's ultimately their decision, and how much money they can lend depends on how much money is available after the fiscal deficit needs are met, and also the rate at which the banks are borrowing, which will be itself affected by not only the rate of inflation, but the expectation of the rate of inflation. So there are many factors that go into determining the long-term rate. I mean, as far as the RBI is concerned, they've signaled in a particular direction. I think that's the right direction. And it will lead to a softening of the interest rate climate, which I think is what the widening of the fiscal space suggests in any case. Plus the fact that the government is taking a number of steps to strengthen growth prospects, remove implementation bottlenecks. That should improve the flow of finance from abroad, and if long-term money flows in from abroad, that will also ease both the interest rate and the liquidity situation.
A last word from you, Dr. Ahluwalia. The skeptics would say that this is just a feel-good rate cut and that it will do little to kickstart the investment cycle. Would you agree with that assessment? Do you think a 0.25% rate cut is going to do little to boost growth or kickstart the investment cycle?
Nowhere in the world does anyone regard repo rate movements as the key instruments for kick-starting industry. If you read the budget speech, or for that matter read the 12th plan, what is needed to restore the momentum of growth to the level that we think is possible, which is kind of maybe 8% over a medium term, but certainly 6.5% in the coming year, it requires much more than simply an adjustment of the repo rate. That's not a surprise, and that should not be a basis for either criticizing the repo rate movement or feeling disappointed. Government's very aware that it has to act on several fronts, and it is actually acting on those fronts. Thanks very much.